Generally speaking, the most important element for an entrepreneur and their financial success is tax strategy, and a close second is asset allocation. Yes, asset allocation. What is that? Kenneth French of vastsolutionsgroup.com. I'm here to help you to understand that very concept. Internally, we call it the benefit distribution, and we do it a little bit differently than most, but for now, we're just going to go ahead and call it what most people call it, and that's asset allocation. I'll explain that in just a moment. For many people, investing typically begins with one stock or one bond or whatever, one mutual fund. Over time, other selections are added to manage the risk associated with investing everything in a single security. However, just spreading money around in a haphazard way may create only an illusion of diversification. If you have assembled a hodgepodge portfolio, it may be difficult to evaluate the extent to which your investments are or are not consistent with your overall objectives. How do you go about setting up a framework that tailors your investments to your particular circumstances? A sound portfolio management strategy begins with asset allocation, defined as dividing your investments among the major asset categories of equities, stocks, bonds, and cash. Since each investment category has a unique characteristic, they rarely rise or fall at the same time. Within each asset category, you can make even finer distinctions. That's my specialty. I love doing that. Combining different asset classes can help reduce risk and improve the overall return of a portfolio. Still, nagging questions would remain. What factors guide the asset allocation process? How much of a portfolio should you put into each specific category? To answer the first question, match the investment characteristics of the various investment categories to the most important aspects of your specific personal profile. That is, your tolerance of risk, your return, your liquidity needs, and your time horizon, etc. Now, investing according to your risk tolerance will help you to keep from abandoning your investment plan during scary times. For example, if you have a low risk tolerance for risk, you may emphasize conservative investments over those that potentially offer higher returns but may involve a greater degree of risk. Return refers to the income and growth you might expect a portfolio to generate in order to meet your objectives. For example, retirees may prefer a portfolio that emphasizes current income, while younger investors may wish to concentrate on potential growth. Your personal time horizon extends from really when you implement investment strategies until you need to begin withdrawing the money from the portfolio. For example, a short time horizon, less than, let's say, 5 years, is probably best served by a conservative portfolio emphasizing the protection of principal. On the other hand, the more time you have to invest, the greater risk you may be able to withstand because you have time to recover from the market downturns, fluctuations, etc. Your final destination. Asset allocation is more of a personal process than a strategy based on a set formula. However, there are guidelines to help establish the general framework of a well-diversified portfolio. For example, you may decide on the need for growth in order to offset the erosion of purchasing power caused by inflation. Now, let's talk about building an investment portfolio that is really right for you. It should involve, matching the risk-return trade-offs of various asset classes to your unique investment profile. One final point, it's worth an emphasis, you should consider all your assets when you put together your own asset allocation strategy. This includes your investments, your business, your retirement savings, etc. Doing so can help ensure that all your assets are working in accordance to meet your goals and specific objectives. Hope this little brief video helped you to understand an extremely important topic of asset allocation. If you have any questions, give us a call at 888-808-8278 or email us. Thanks again.